Good afternoon. Good afternoon. Happy Friday, everyone. Welcome. Welcome to Business Basics Friday. I am Safi Russell. Go ahead and share if you're here live where you're joining us from. We are here in New York and it is 54 degrees today, so we're getting there now that it's officially spring. Um, Go ahead and share where you're joining us from. If you're here in Clubhouse, go ahead and share it on the back channel. And if you're on Facebook, go ahead and post it in the comments. Let me just get my live pulled up so I can see your comments. So bear with me 1 minute and then we're going to get started. All right, hope everyone had a great week so far. It's been a busy week here in the middle of tax season. I know I'm crazy for being on here right now, but it's okay. Okay, there we go. Got all technology worked out. All right, so we're going to go ahead and get started and hopefully everyone can hear me okay. So if you're joining us here for the first time, I'm Safietou Russell, CEO and founder of SDR Consulting, Inc. And welcome to Business Basics Friday. This is a weekly session catered to providing valuable information to business owners. We have different guest speakers as well as myself to share information and education in the areas of business ownership and all the different tasks that you may manage in your business. Just for disclosure, this is strictly educational, informational. This does not create a client relationship. As far as my background, I've been in the industry 20 years and I'm a CPA and enrolled agent and also have my master's in taxation. SDR Consulting Inc. is a virtual firm and we are based in New York, but we service clients all over the US. And we mostly work with business owners helping to provide startup services as well as cleanup for those who have gotten into trouble with their books or taxes or IRS. In terms of startup, we help with consulting, bookkeeping setup, as well as tax preparation and planning. So if you do have questions, go ahead and put them in the comments, or if you're on Clubhouse in the back channel, and we'll go over them at the end. Today, I'll be covering a Q&A session. So welcome to the CPA Q&A session that we're having for today. And so I have a few questions that were submitted ahead of time that I will review. But like I said, if you're here live and you do have a question, go ahead and post it and I will get to those at the end. All right, so, you know, in the middle of tax season, there are a lot of things we come across, and one of the questions I received was regarding filing with a spouse and having prior tax debt or other debts and how that could affect them. And I think it's a great time to talk about that because first, let's kind of discuss what your filing options are when you are married. If you're married by year end, even if you got married on December 30th, your filing status options change. At that point, you are married filing joint or married filing separately. And there's always, exceptions, which I won't go through, but generally that's your options. You're no longer single. So if you're going to file jointly with your spouse, what that means is that you guys are both jointly and severally liable for any tax debts related to the IRS or state. So let's say, you get married November 30th, your spouse has some tax debt maybe you didn't know about. As soon as you file that joint return, you're going to both start getting bills for any outstanding tax debts. Now that you've attached yourself to your spouse in terms of your joint liability. And that means that even if you did separate for the years that you filed joint, you're going to have that liability over your head as well until one of you resolves it. So that is definitely a discussion to have in going into a relationship and going into a marriage. Sometimes you got to pull their transcript and get an idea of what's going on. This can also be an affect you if there's any child support or student loans in debt because they can pull that from your refunds. So if your spouse has child support that's unpaid and you guys file jointly and because you filed jointly, you're now getting a refund, that refund can definitely be pulled for that past debt. Now, there's different ways you can get around that as the spouse who may be injured or innocent. There's different reliefs related to that you can file. However, when you file jointly, you're now subjecting yourself to that. So if you do marry your partner, you want to make sure you understand what debts exist, whether it be tax related, child support related, student loan related. Those are the main ones I can discuss. I'm sure legally there could be other things that may be an impact, but as it as it relates to your income tax refund, those are the things that could be confiscated by filing jointly. So the reason why spouses file separately is they want to separate that liability. So maybe one spouse has no debts, would get a refund, good to go. They'll file based on that and they should get their refund. And then the other who owes, they'll just be individually liable for that debt. So hopefully that answers that question and help you make a decision. When you're a business owner, if you're not in the habit of paying your taxes quarterly, you can get into this position where at the end you go to file and you owe. And so when you file jointly, that's something to keep in mind. And so once you file, you want to do this ahead of time. So sometime you can do a comparison between filing jointly and filing separately just to see overall how it affects your taxes, because for other reasons, such as some of the downfalls of filing separately, it may be beneficial to still file together. There's certain credits that you may not get if you file separately versus jointly. So just, definitely work with a professional to maybe do that analysis and determine what makes more sense. But do keep in mind when you file jointly, you will be subject to those tax liabilities, not even just for that year, but for the previous years. So another popular question I think that got the most votes is, as a business owner, how do I pay myself? And so this is going to vary depending on the type of business you have set up, your structure, elections that you may have made. So let's just start from the bare minimum basics. If you're a sole proprietor, you're self-employed, maybe you have a side hustle, maybe you do it full time, but you have no formal entity structure, you can pretty much pay yourself freely. Now, when you pay yourself, there should be a good trail. So you should have a business account regardless, or some type of separate account where you run your business. And any profit remaining in that account, you're going to be taxed on it regardless. So if you take the money out or leave the money in the bank, you're not taxed on what you take out. You're taxed on what profit you make. So if you earned 100,000 from customers and your cost was 50,000, not including your pay, you have $50,000 of net income, taxable income that would be taxed. If you left that 50,000 in the bank, you're still going to be taxed on that number. So when you do take that money out, you want to make sure there's a trail. You want to make sure you either write yourself a check, which is, outdated right now. You can do a transfer, you can do a Zelle. You just want to have a record of that money going from yourself to from your business to yourself. And that is pretty much considered an owner's draw, owner distribution. It's not considered pay in terms of payroll and tax, perspective. It's not a deduction when you take money out for yourself personally. You're just pretty much withdrawing your equity out of the company. So if you're a sole proprietor, you have a DBA, or if you're just self-employed, or if you have a side hustle, really no formal way to pay yourself. You just want to have a good trail of where that money's going and make sure you're not counting it as an expense. Now, if you are a partnership, let's say you're an LLC with multiple members, or you just have a general partnership, it's almost the same in that you're just going to take a withdrawal. This is not, you can't pay yourself as an employee in either one of those structures. It's not an expense to the company, but you can take an owner's draw or distribution out of the partnership. The difference with a partnership is there could be something in your operating agreement, which is a written agreement you should have between all partners, that tells you the rules of taking distributions. So you have your ownership percentage, you have your capital investment. There may be some criteria in there in the way you take distributions. So that's something that should be looked at before you just freely take money out of the account. And you also don't want to take out more than you have invested and earned in the partnership, because when you're dealing with multiple partners, you can actually take out more money than you should and cause yourself to have to recognize a capital gain. So, it gets more structured as your entity changes, in terms of how you have to pay yourself. So that's why it's important to know what structure you are and how you're taxed. So we covered sole proprietor, self-employed, we covered partnership. Now let's talk about corporations. If you are a corporation, whether you started as a corporation and you just stayed as a C Corp, or if you're a corporation and you made an S election, or you're an LLC who made an S election. Those are the three ways that you become a corporation for tax purposes. So let's talk about the S Corps first. So with an S Corp, just keep in mind an S Corp is not a structure, it's a election. It is an election. So you're either an LLC or you're a corporation that makes an election to be taxed as a S corporation. You're going to be other entity types as well, but those are the main two. So let's say you're an S corp now. As an S corp, in terms of for tax purposes, you are required to pay yourself a reasonable compensation if you're providing services to the company. If you're not taking any money out, you may not have to, do that just yet. But if you're starting to take money out, if you're taking money withdrawals out of the business account, writing yourself checks, et cetera, the IRS wants that to come out first as a W-2 employee pay. Then you can take distributions. So how do you pay yourself if you're an S corp? You need to be registered with the state as an employer, your company. You would then be an employee. You should have a payroll service to help run payroll for you, to determine and then determine how often you're going to pay yourself, all that stuff, your withholding, all that jazz. And reasonable compensation is the key. That's the amount the IRS wants to see at minimum, you paying yourself as an employee before you start taking distributions on top of that. Now, what is reasonable compensation? I wish it was that easy, right? It's not a black and white answer. And it's going to vary based on a couple of factors: where you're located, what's the market rate for the role you're playing in your business, how many hours you're working in your business, the different roles you play in your business. So there's the part where you're servicing your clients, but then there's the part where you're running your business, the administrative costs, the janitor costs, the technology costs, the marketing costs. All those different jobs have different rates. And so you really need to have like a blended rate to determine what your reasonable comp is and how many people are going to really sit down and do the research for all of that. Well, great thing is that that's a service we offer, to do a reasonable compensation assessment for an S corp. So once you determine what that number is, now you're going to look at, okay, how much profit am I making before my expense, before my salary? Well, if your reasonable comp assessment is $50,000 and you have $50,000 of profit left after your other expenses, guess what? You're paying out all your profit as a W-2 employee to yourself, which is not the worst thing. You're going to have taxes taken out during the year. You won't really have any profit left over to pass through, and maybe not have any estimated taxes. But you're not really maximizing the purpose of the S corp, which is to save on payroll taxes and self-employment taxes. So that's why before making the decision to be an S corp, you should always have an analysis done to see if it makes sense. If your reasonable compensation is high and you're not that profitable yet, it may not make sense to incur the extra costs to run an S corp versus just staying as an LLC until maybe you've crossed that, now you're at $100,000 of profit remaining and you only got to pay yourself 50. Well, now you can save about 15% on that other 50,000. So long story short, when you're an S corp, the way you pay yourself is definitely more structured. You have to be an employee if you're going to be able to take money out of the company, and you need to determine with proper research how much you should be paying yourself as an employee. And if there's any profit remaining, then you can take distributions in the way that I mentioned, where you write yourself a check, preferably not checks, do a transfer, Zelle, and so on. So definitely you get into a more formal structure of paying yourself when you are an S corp. And if you do have an S corp in place and you are profitable and you don't have payroll in place, that is a red flag to the IRS. If you're taking money out of that S corp as a distribution and not as payroll, the IRS can reclass those distributions as salary and charge you late payroll tax penalties and interest, late filing penalties, et cetera. It is a red flag to have an S corp and take distributions without a payroll for yourself. So please keep that in mind. For those who have rushed into getting an S corp, you can revoke it and then you can't do it again for 5 years. But if you do have it in place, you want to at least follow the rules. Now, if you're just a C corporation, you have not made an S election, there are rules for reasonable compensation just the same. You need to be on salary as an employee if you're providing services. And the key is with a C corp, because the C corp can result in double taxation when you take distributions or dividends, is what it's referred to. Most people in a C corp are going to try to maximize their wages so that they can avoid the double taxation. So once again, it's important to run the numbers to see when a C corp would make sense, because in some instances it does, even with double taxation. But at the end of the day, some people will try to maximize their salary in order to avoid the dividends, double taxation effect. So there's reasonable compensation in both C Corps and S Corps. It's just kind of opposite what's considered a red flag to the IRS. So at the end of the day, those have more structured ways of paying yourself, where it needs to be through a salary, through a payroll service, corporate or C Corp or S Corp, whereas the sole proprietor and partnerships are a little more lax in how you pay yourself. So I hope that answered that question. It's not an easy answer, but if you're not a corporation, ultimately you are more flexible in the way you pay yourself. It's just not an expense at that point. It's just removal of your equity. So that kind of follows behind a question that I saw of setting up an LLC or an S Corp. A very common question as well. And this is always going to depend on the numbers for me. Everyone makes that analysis and that decision differently. Some people come to me knowing what they want to do already. Okay, that's fine as long as they've done the research. I'm going to make sure they understand if you're an S Corp, this is what's needed. So that decision of whether just to stay as an LLC or make the S election or set up a corporation and make the S election really should be based on the numbers and the compliance, right? So the numbers meaning the tax savings of both and also the cost to maintain both and your tolerance for compliance. So if you know you're not someone who's going to be, paying yourself on a regular schedule, adhering to labor rules and running payroll through a payroll service and paying taxes with each paycheck, you're probably not going to be a good fit for an S Corp, right? So that's something to consider. If you're in a state, for example, in New York, where New York City doesn't recognize S Corps, it may not be as beneficial for you versus someone who's in Texas who has no state income tax at all. So just be careful when you're like browsing YouTube and TikTok and watching these videos and having people promote things to you when they're not in your specific situation. The LLC or S Corp decision, in my opinion, should always be made based on the numbers because they both provide liability protection if treated properly. So there's really no difference there, in my opinion. I'm not a lawyer, right? But it really comes down to the tax savings and the compliance factor. So when you have payroll, you have to have a payroll service because for you to try to keep up with your payroll tax payments by yourself is not feasible. You're going to have unemployment insurance, which can vary per state and based on the role you're doing in your business. Some states can require workers' comp insurance, even for you as the owner. So those are additional costs that you wouldn't have if you were in an S Corp. So those are the things I would consider when making that decision of LLC or S Corp. Number one, get an analysis done to see what makes more sense, and then make sure to factor in all those other variables. The last question I got up front here was about estimated taxes. And just a reminder for anyone who's plugging in, if you do have a question, go ahead and post it in the Clubhouse back channel, or you can raise your hand to come up on stage. I can have you speak. And then if you're here on Facebook Live, post it in the comments. Estimated taxes. So there's a lot of confusion with estimated taxes for business owners because most businesses, the most common ones are flow-through entities, pass-through entities, which means that your business activity is going to eventually flow down to your personal taxes and your tax liability is going to be paid there. So generally, when talking about estimated taxes that are paid quarterly throughout the year, we have to factor in your business plus everything you have going on personally to determine if you need to pay estimates. There are some states where the business itself does pay taxes. California, for example, S Corporation has a 1.5% tax or a minimum fee. And so there may be estimates related to that. New York City doesn't recognize S Corp, so the corporation is taxed as a C Corp and it may have to make estimated payments. So those are different scenarios, but generally, when it comes to your usual estimated taxes, it's done at the individual level. So if you have a partnership, you get your share of the partnership's profit delivered to you on a Schedule K-1. You take that Schedule K-1, you put it into your individual tax filing, and it's combined with all your other income and expenses. Then your tax liability is determined. For IRS purposes, if you're going to owe more than $1,000 when you file your taxes, you may be hit with an estimated tax penalty for not paying that money quarterly throughout the year. So that's a really low threshold. So there's different factors that go into that calculation and that I won't bore you with. But if you're going to owe more than 1,000 year after year, you're probably getting hit with some type of estimated tax penalty for not paying it during the year. So in order to avoid that, you want to have quarterly projections done that are going to factor in your business and anything personally going on so that you can calculate those payments and make them quarterly. Now we're in March of 2022. The next quarterly payment is due April 18th, 2022. It's usually April 15th, but there's some holiday going on this year. So between usually April 15th, just go by that. April 15th is the first quarterly payment for 2022. So for everybody filing now, yes, you're filing taxes from last year, you may have taxes owed, et cetera, but you also got to prepare for 2022 filing by paying an estimated taxes by that same due date of April 15th or 18th this year. So it's important to have a regular bookkeeping in place so you know what your numbers are. Have that looked at throughout the year if you don't have someone doing it for you, so that your numbers are right, so that whenever it's time to run that projection, you can do it. You know, you can get your latest pay stub if you're still working, combine that with your business activity. Boom, what does the tax look like for federal and state? So state, you know, thresholds are usually a little bit lower. I believe New York State may be 400, give or take. So estimated taxes are usually made at the federal and the state level if you're in a state that has income tax. So long story short, estimated taxes are, when people refer to having quarterly payments to make, they're most likely referring to those estimated taxes. You only need to pay estimated taxes if you're going to owe a certain amount when you file taxes. If your business is running at a loss and your other income and expenses related to you personally are covered, meaning you have a job and you have enough withholding, you may not have to make quarterly estimated tax payments. It's not mandatory unless you're going to owe. So estimated taxes, once again, generally paid under your personal account. When you pay that in, you're paying under your social security number, even though it may factor in your business activity. All right, so I hope that answered the question on estimated taxes. So those are all the questions I got submitted ahead of time. I'm going to stay on for a few more minutes. If anyone has a question they want to ask, feel free. Don't be shy. Now is the time, you know, to get a question generally answered for free. So if you're here on Clubhouse, you can definitely raise a hand and I'll bring you up on the audience. Yeah, you can send a message through the back channel as well. And if you are here on Facebook, feel free to post your question. I'm just going to pull up a second screen just to check if there's any questions in the Facebook group. All right. Okay, cool. All right, I'm not seeing anything just yet. So in closing, I will actually go ahead and just share something that I've seen recently and I see every year that I just want to address in terms of certain deductions you can take as a business owner. And because, you know, the world is starting to open up again, people are out and about. So I figured I'd cover this last topic. It's about claiming vehicle-related expenses. So if you have a business that requires you to use your personal vehicle for your business, whether it be running errands, whether it be, you know, you provide a rideshare service, such as Uber or Lyft, it is very, very important that you track your miles. Without tracking your miles, it makes it very difficult to determine which way you should be deducting your vehicle-related expenses for business and what number that is, right? There's no standard minimum flat mileage or vehicle deduction that you can take. It's going to come from the information you provide. So when you have a vehicle and let's say the vehicle is not owned by the business, so the title's not in the business's name, it is in your name. Generally, you're going to be able to deduct it. You're going to be able to deduct standard mileage, which ranges between 56 and 58 cents a mile, give or take, depending on the year. So that amount of cents per mile, or you can take actual expenses, but you can't take both. So actual expenses would cover things like gas, maintenance, insurance, registration costs, depreciation on the purchase of the vehicle. Those are the type of costs you can account for with actual expenses versus standard, kind of as a blended rate to factor in all those things, right? Now, in order to determine how much of those actual expenses you can take, guess what? You have to determine what your business use is. Because if you're using one vehicle for both business and personal, there's no way you can deduct all your gas for the year. And there's no way you can assign your gas to each business trip, right? Because your gas is probably going to last for well, nowadays, who knows, but your gas may last 2-3 days, or it could last a week, and you have business and personal trips during that time. So we're at a time where gas prices are a little high right now. So your mileage is going to help determine that. So if you drive your car 50% business, 50% personal, that means 50% of those actual expenses is what you can deduct for business purposes. Without having that mileage, how do you know? How can you prove it? More importantly, if the IRS audited you, how can you prove that you're 50-50 without mileage, right? A calendar. You can recreate your mileage log if you're not tracking it. But I recommend just getting an app. There's many apps out there. We've used a few. We use QuickBooks Online primarily here at SCR Consulting, and they have mileage tracking right within the app now. So it's very easy to just download an app that'll track all of your miles while you're driving. And all you simply have to do is come in and say, swipe left or right for business or personal. And if it's business, what was the purpose? You're creating your log all throughout the year, which makes it much easier at tax time to make those determinations. So we're in March now, not too late. You can go back and backtrack from January to March, what you've done so far, and then use that app to automatically capture it going forward. When you purchase a vehicle, if you didn't purchase it in the business name, it's not a business vehicle, right? But you can account for some of the costs if you use the actual method on the purchase price. So if you bought the car for $25,000, it depends on the type of car, how many pounds it weighs, things like that. That determines how much you can deduct. And also your business use will determine how much you can deduct upfront for the cost of the vehicle. But you're not writing the full $25,000 off in most cases, especially if it's not a business vehicle. So keep your bill of sale, so you know exactly what you paid for the vehicle, know the details about the vehicle so that your professional can help you with that. And most importantly, please track your miles, okay? If there's no takeaway, if there's just a simple takeaway, just track your miles. That will help you to figure out which one makes sense. Now, if it's your first year claiming that vehicle for business, if you take the standard mileage that year, then in the future, you can switch back and forth between actual and standard, depending on which is higher. Ideally, you would want to go with the one that's higher because that's more of a bigger deduction. But you can only do that if you take the standard in your first year. If you take actual your first year, you have to take actual every year after that. Now, the reason why that could be a downfall is because, yes, you may get a big deduction in the first year because you purchased the car, you've met the minimum business use percentage, and you can deduct a good portion of that purchase price. But in the future, if your maintenance is low, if your gas charges are not that high, your deduction in the future may actually be lower than if you would have taken standard that year, but you don't have the option to switch if you use actual in the first year. So these are, the little nuances to keep in mind when determining which option to go with. Yes, one might sound nice in the beginning, may give you a higher deduction in that year one, but if you want to be able to switch between standard and actual going forward, you need to take standard in your first year. And there's different rules as it relates to leases. I'm just talking really as it relates to financed or owned cars. There's different rules for leases that I won't dive into today. So, all right, guys. So I hope that helped. Thank you for joining us for this, joining me today for the CPA Q&A session. If you have a question, feel free to throw it in. If not, go ahead and post it after the fact. And the next time we do this, either myself or a guest speaker will cover those answers for you. The goal is to, answer your questions, help you learn what it takes to run your business from the financial, tax, and accounting side, so that even if you have a professional handle it for you, which I recommend, that you still understand what's going on, and so that it's you understand your business. Okay, we have a question here I'm going to bring up. 1 second. Okay. Here on Clubhouse, bear with me while I load this. Okay. Hi, Donette, how are you?
Hi, Safie. Happy Friday.
Happy Friday. All is well, thank you.
So my question is around the mileage and what's the best way for tracking it? Because it's so easy to forget, when you're going somewhere, to take note of your mileage. Is there an app or I don't know?
Yeah, definitely with an app. Everything's an app nowadays. So if you have QuickBooks Online, right, then Yep. So it's actually a feature in QuickBooks now for all versions, my understanding. So if you download that QuickBooks Online app, within there should be a mileage tab, and then you can enable your location so that it will track your miles every time you take a drive. So just keep that in mind. Every time you get in your car, it's going to track that, and you'll have to come in and tell it if it's personal or business.
Oh, I see. Okay.
That's what I recommend. Yeah.
All right. Thank you so
You're
much. Appreciate
welcome.
it.
Absolutely. Thanks for your question. So that's one of the options out there. There are other mileage trackers out there. MileIQ is another popular one, but just do what works. Just find one that works. That's the main thing. One that works, and that's going to keep up to date with your trips. All right. All right. So any other questions here on Clubhouse or Facebook? If not, we'll go ahead and wrap it up for this session. And I want to thank everybody for joining on the CPA Q&A session today. So as far as our next session, we will be back in 2 weeks. So not next Friday, but the Friday the 8th, 12 o'clock Eastern for our next Business Basics Friday session. So feel free to invite a friend. If you come up with a question afterwards, feel free to keep sending them. We may do this session again on that 8th, or I'll have a guest speaker for that day. So we're going to wrap it up. If you're joining late, I'm Safie Russell, CEO and founder of SDR Consulting, Inc. We work mostly with business owners, helping with business startup and business cleanup services, and that entails consulting, bookkeeping setup, tax preparation and planning, as well as cleanup if you've gotten behind with those tasks and or have issues with the IRS or state. All right, so everyone enjoy your Friday. Have a great weekend. Enjoy spring. If hopefully the weather will warm up next week and we can get into that springtime. And I'll see you again in 2 weeks. Take care. Bye-bye.